So guys, a little bit of a controversial video last time where I was disproving smart money concepts. Now, a fair criticism that, a couple of people made was that I didn't provide enough evidence for my points. They were more based upon logic and reasoning and these sorts of things. And so they thought that there was more of an opinion of mine. I'm going to prove in this video, the best that I can, that it's not a opinion. It's based on data, it's based on studies. I've actually put together a document referencing what I think are the most important studies for each of the points that I made in the last video. So if you had any doubts about the last one, or you just enjoy watching me pull down my pants and do a massive shit on the heads of all of those people who follow SMC, I am joking. Like, I used to like SMC. This is not me shitting on SMC. It's mainly me shitting on the idea that SMC is just a variation of technical analysis, albeit a more complicated one, and talking about how technical analysis as a general rule is fairly limited in terms of providing a real edge, especially in highly liquid markets such as the FX markets. But if that was a bit of a word salad for you, then let's just get on to detail. So the first point that I made yesterday was the idea that market manipulation is happening to exploit retail traders specifically. It's the idea that, stops are about to be run here, buy side liquidity, sell side liquidity, whatever the hell anybody wants to wrap it up with in their neat little bow tie, or however you understand it. Just that is what I'm talking about for this point. Now, my key points against this were there's no scientific evidence to back it up. In fact, there's scientific evidence proving that it isn't true, which I'll go on to in a minute. Then it was that the markets are not that simple. The idea that institutions can just decide to come and take stop losses on a consistent basis, at least, it's really just so incorrect. Again, I'll provide my best presentation for why this is in a moment. Next one is there isn't one type of institution. There are literally thousands of different types of institutions, all with their different ideas and methods and goals and time periods that they're looking at and all these sorts of things. And then the last point is, why would they bother manipulating retail traders, especially in an FX market where, about 5 to maybe 10% of retail traders make up the total volume of the market? Why would they bother going after that tiny group? So let's break this down. So this is that first point that I was talking about. My main counterpoint in a nutshell is institutions exist, but there is no scientific evidence supporting the notion that they systematically trap retail traders. So what are the three main points? Efficient market hypothesis. So for those of you that don't know, this was pioneered by Eugene Fama, and it states that financial markets are informationally efficient, right? So this means that, and it uses the example of stock prices, but all markets are basically working off the same premise. It is impossible to consistently trap or exploit any subset of market participants over time. This theory, and I want to make this very, very clear. When you see me using the word theory throughout this video, I want to make this so clear. It's very easy for us to hear the word theory and go, oh, it's not proven or it's false. And it opens the door for people who are already predisposed to believe something, such as SMC, to be like, okay, it's a theory, therefore they haven't proven that SMC is wrong. I'm going to give you an example in the real world. The theory of evolution. Now, we may have some conspiracy theorists watching this video, right? But believe it or not, the theory of evolution has holes in it. It's not a perfect theory. However, that doesn't mean it's wrong. Just because something has holes in it doesn't mean it's wrong. The theory of evolution, you know what it does have? It has, I don't know the exact number, but it has, I would imagine, multiple tens of thousands of pieces of evidence that support the theory. This is really a big deal. Because what most people will do is they will say, again, I'm just paraphrasing here, but they'll say, okay, if it's a theory, it's not proven. Therefore, if it's not proven, then my other theory is just as valid as this other theory. That is that's a massive lie. Why? Because of the pieces of evidence. If we use SMC as an example, let's just say you believe that SMC is right. Just because the SMC is a theory and some of the theories that I'm talking about is also a theory, that doesn't mean that SMC is just as valid as this, because a theory that is based on more evidence and more complex calculations that have been scientifically validated is far more of an accurate guess than just saying, oh, well, I saw someone in a YouTube video talk about how the market's ruled by whatever. That is just ridiculous. Anyway, a little bit of a rant there, but it's very, very important to understand that when I talk about these are theories that are based on people who are far more intelligent than myself and probably most of the people watching this, and that's fine. They're going into complex calculations that the vast majority of people watching this, myself included, cannot do and don't want to do. And so we are leveraging the knowledge of those who are very, very smart. I will also explain the weaknesses in some of these theories that I see and also why that still factors into my own opinion. So anyway, this theory, the efficient market hypothesis, is widely accepted and has been tested in various markets. Studies such as stock market prices do not follow random walks by Lowe and however you say that, McKinley in 1988 provide evidence that while there are short-term deviations from EMH, they do not support systematic manipulation of retail traders. So what is this saying in short? The markets are trying to price in value. The prices that you are seeing at current time are basically a reflection of the widely known information available and deciding a value based on that. Now, what it means is in the short term, there are deviations from it. The easiest example of that is, let's just say that we have a news event coming out here. We don't know what the outcome is that going to be. We don't know what the outcome of that is going to be. And so because there is new information, especially if it's big new information, that's why we'll sometimes see huge moves. Now, that can be something like that. It can just be a much more unstable range, or it can be a big drop down here, right? But the truth is, it doesn't really matter for the point that I'm making here, because when new information comes out, the market rapidly tries to price that new movement in, right? And so when we are dealing with the efficient market hypothesis in relation to my the idea that anybody is capable of just pushing prices consistently to a certain point in price just because they want to eat up retail liquidity, it doesn't really make any sense. Okay, now if you want to look into more detail into that specific point, then go and research the efficient market hypothesis and research it in more detail, such as this study as well will also be very, very helpful. Now, keep in mind, a lot of these studies are very, very boring to read through, and a lot of them are very, very complicated. You can get a lot of the information you need just from reading the abstract or the introduction and the conclusion, rather than going through all of the charts and the results and all these sorts of things. Or if it's too complicated, you can maybe ask ChatGPT to simplify it down, or whatever the hell you want to do. There's lots of options available now. So next one is no empirical research for retail trapping. So a study by, I'm not even going to try and pronounce that, called Institutional Investors in Stock Market Volatility shows that large institutions often aim to minimize volatility when making large trades. Their strategies are designed around managing liquidity rather than targeting retail traders. The sole purpose of this theory and this study, I should say, is not just to disprove this one point. This point is a byproduct of this study. So the sole purpose of the study, you're not going to read through it and be like, oh, it doesn't mention that retail traders aren't getting trapped. It will mention it, but it doesn't mention it as the main focus of the article. This is what I mean. Sometimes these things are in the, as a side point to the main thing. If you study one thing, you'll find that what you're studying has ripple effects across lots of other things. And this is an example of one of those ripple effects, right? In addition, institutional traders focus on large block trades and broader market factors, not small retail trades, which usually make up a minor portion of the overall volume. Again, research this if you disagree with me. My purpose, and I did have an argument with a few people in the comments on the last video. I said, disprove. If you don't agree with it, disprove it. I think people took that as me saying, oh, I can't prove what I'm talking about, therefore I'm asking people to disprove it. No, I'm just using it as a normal part of human conversation. If I present something and you don't agree with it, tell me why you don't agree with it. And then I will do my best to prove that, prove my point, make my position clearer, and vice versa, I hope. Anyway, next one is market complexity, right? So I can't talk today. Research by French and Roll, 1986, suggests that price fluctuations are largely driven by the arrival of new information, not manipulation by large institutions. Why is this important? Because remember what I said about the efficient market hypothesis. The markets are trying to price in value. Therefore, when new information comes out, markets are rapidly trying to price it in. That is why markets price things in so rapidly. If you go to a 1 minute time frame and you see how quickly things react, especially to big news events, you'll see that markets price it in almost instantly. People are trying to price it in so fast. If the markets weren't very good at pricing things in, it would be a really big delay. Let's say a news event came out here, you'd see it would just maybe it would slowly get there, and then over time it would get more. But instead, we normally see instant reactions or near instant reactions. And that is an example, a very, very anecdotal and straight up example of the speed at which things are usually priced in. But really, it's about market complexity. The idea that there is anything, well, we'll get to that point in a minute, but the markets are complicated, guys. Don't get it twisted. Anyway, why is this relevant? EMH and the related studies demonstrate that markets are too complex and efficient for sustained manipulation aimed at retail traders. And then an additional point to this is that retail traders are a really poor target. It would make much more sense for them to target other institutions rather than retail traders. Anyway, that's that point done. Next one, institutions targeting large liquidity pools. So the idea that, let's just say we have, I believe, equal lows. People are like, oh, there'll be resting liquidity there, which means that when we come back down here, we're likely to swoop it. Now, this may happen. That doesn't prove that the theory that underpins that idea is right just because it happens once. You could have examples of anything working. You could have the idea of a triple top, triple bottom forming, working, where it comes down and then bounces off perfectly. Those people will look at that example and be like, see, it works. Even if you test things over a large enough sample size, you're still not factoring in market conditions changing, environments changing, all these other sorts of factors as well. And so to look at even a sample size of backtested data is still largely going to be wrong. Anyway, empirical research. So fragmented liquidity. So studies on high frequency trading and market fragmentation shows that liquidity is dispersed across multiple venues. In the flash crash, the impact of high frequency trading on an electronic market, by a name that I'm not going to try and pronounce again, the authors found that high frequency trading, or HFT, does not lead to manipulation, but rather creates a more complex market where liquidity is constantly redistributed across multiple platforms and asset types. I don't know how this can be clearer than what it says right there. The study showed that the behavior of liquidity providers is more dynamic than simply targeting pools that retail traders may identify with. Again, going back to the key point here, the markets are highly, highly complicated. Believe it or not, some person in their basement or in their bedroom or even in their office, if they're really trying to be fancy about it, didn't come and solve a fundamental thing about the market. It just doesn't happen like that. If it happened like that, the world would be a very, very different place. Next point, diverse strategies among institutions. In institutional trading and stock returns by, I'll give this one a go, fuck it. Nove Singer and Cias, 1999, the authors found that institutions often have varying risk profiles and strategies, meaning their actions are far from homogeneous. Now, of course, a SMC counter argument to this would be like, oh, yes, but what we're talking about is above the institutions. It's a magical entity that even supersedes them. They respond to this magical entity. We'll get on to why that's also a complete lie as well in a minute. This variation resulting in different market objectives, further debunking the idea that institutions work in unison to manipulate retail traders via liquidity targeting. Next point, limit order book studies, right? So research such as the microstructure of the limit order book, so Bias, Gloston, and Spat demonstrates that the market order book is a decentralized auction. I'll talk more about auctions in a minute, where liquidity is provided by many actors, including retail and institutional participants. The market isn't driven by singular, visible pools of liquidity, but rather the continuous matching of bids and offers. I showed you an example of this in the last video. Yes, I only showed an image, but you are more than welcome to go and explore this platform. I don't want to make this video desperately long and and boring, but you see where we have these really high concentrated red zones. These are areas of high passive liquidity, or limit orders, in other words, at these levels. And the fact that they sustain there until price comes into there means that they have been absorbed, etc., etc. And then you have active liquidity as well, active orders. So that would be something that, like, a footprint would show up. This is basically market orders in the market. But essentially, if you look at how one of these things moves, you're more than welcome to look at videos of it online. You will see how they move. Liquidity is coming in and out at all times, and especially in a highly liquid environment like FX, you're going to see consistently that it is very, very difficult to say with certainty that there is liquidity resting at any sort of level. It's very easy for a retail trader to come on here, for example, and say, "Oh my God, look, we've got equal highs here, so we're gonna sweep them," or whatever. But if you actually look at these types of charts, you'll see how much of an effect it really has. And the answer is not as much as you think. Let's go on to the next point. So just again, to kind of solidify the point I was making here, scientific studies on high frequency trading and market microstructure illustrate that liquidity is dispersed and dynamic, making the idea of targeted liquidity pools overly simplistic and empirically unsupported. Next point. There is a magic centralized algorithm that drives prices. So I'm not talking about algorithms in the sense of the type of algorithm that you or I could use, or that an institution could use. It's the idea that there's this magical entity floating up in the clouds that can drive prices with its magic algorithm. My counterpoint is that the markets are auctions and they're not driven by a central algorithm. A very, very simple and a very, very humble point. But let's go into the auction theory, because that was another thing that a few people had an issue with in the last video. So again, I want to highlight the word theory, because just because it is a theory doesn't mean it isn't true. Modern financial markets operate as continuous auctions where prices are set through the interaction of supply and demand. This auction-based model is well established in market microstructure literature. Limit order book as a market for liquidity provides evidence of how orders get matched in auction-like environments, reinforcing the idea that price discovery is decentralized. The price-setting mechanism is transparent and decentralized and not centrally controlled by an algorithm. Key words here. The key word really is decentralized and auction-like environments. Why? If you go to an auction, you've got this little guy right up at the front here, and you've got all of the different people that he is calling out the things. He's going, right, have I got $100? Have I got $200, $300? Four sold for $400, right? That is working because the auction deliverer, I don't know what they're called, auctioneer, is giving the potential prices to the audience, to the participants, and then based on what is agreed as the most fair value for one of those people, that is going to be bought by, let's just say, this person wins, not the other way around. The idea that there's a magic algorithm above price literally flips this on its head, because it's basically like saying, instead of lots of market participants auctioning for the price, instead what it is it's one magic person that is delivering the price. But I mean, it just looks ridiculous. I know this diagram's, so informal, but you know what I mean. And all of the research, all of the evidence using very sophisticated models points to the idea that the price discovery is decentralized, meaning it isn't a single entity floating in the clouds and presenting a price based on what it wants to do. No, it presents a varying level of market prices as we are presented with the market. And based on that, the participants will decide what is a fair value. And how do they do that? They do it based on information. And information is priced in really quickly, as we know from the efficient market hypothesis, right? Again, you can see it here. You'll see it with the DOM. If we just zoom into this, for example, that did not work. If we look here on the right-hand side, you'll see the DOM. This is just basically saying the depth of market, shows the limit orders essentially in the market that have been placed. And you can see here how the market interacts. I'd recommend that you would watch this on a YouTube video, or if you've got a platform that supports depth of market with real data, so that's not going to be FX, it's going to be the futures market or something like that, then I'd recommend doing that, because you will see what a real auction actually looks like. This is why anybody who has used these methods typically never falls for SMC, because why would you if you've seen clear evidence that the market is moving in a certain way based off certain principles? Anyway, let's go on to the next point. The myth of essential algorithm. Research from algorithmic trading and price formation in the foreign exchange market shows that while algorithms are used by market participants to execute trades, they do not drive prices in a top-down manner. Basically, another way of saying what I said before, it's not that they drive prices in a top-down manner. Yes, this is talking about specific algorithms like you or I could use, but it's the same premise. It doesn't matter whether it's you or I using it or whether it's a magic magician who's got more money than sense and they are driving the market. They can't really drive prices because of all of the things talked about in this study, right? These algorithms react to market conditions rather than control them, participating in the price discovery process like any other trader. Relevance. The auction theory of market operation is a well-established fact. An empirical research on algorithmic trading shows that algorithms are tools for order execution, not central price drivers. And again, if you want to disagree with this research, what I would recommend you doing is downloading every single bit of research that I've presented here, understanding what it means on an intricate level, not just kind of a surface level understanding, and break it down and disprove what is said in those research papers, because they are very, very methodical. They're incredibly scientific. They actively, at least most of them actively, look for ways and reasons that they could be wrong, and they look to explore that further. That's what true science is about. It's not, hey guys, I have this theory where like this magical force is moving the market, and like just watch my special complicated version of technical analysis and it will have this impact. It's not that, because that's ridiculous. Anyway, next point: common patterns, indicators, and price action manipulation. So the idea here, I believe, I'll just go back and double check so I don't butcher this. I believe point 4 was common patterns and indicators and price action is intentionally used to manipulate you. So kind of similar to the previous points, but let's just drill it home. My counterpoint in a sentence is the suggestion that patterns and indicators are used for manipulation is contradictory, because SMC strategies themselves use pattern recognition. If you go back in the chart, let's just say you're a big SMC person. What are the big SMC things these days? Fair value gaps, imbalances, order blocks, equal highs and lows, which I'm just abbreviating here. Turtle soup, which is just basically a fancy name for raiding a high or a low, then coming back in and then basically trading it after the liquidity swoop has happened. So basically something like this. Yeah, the idea that's like, oh, well, it's swooped quote unquote liquidity here, and then I look to get involved around about here, whatever the hell they want to call it, right? You want to know something funny? This is just a technical analysis pattern. You can wrap any theory around it that you want. I'll give you an example right now. Let's take a pattern that most SMC guys are really going to hate. Let's take a really obvious zone above price. Let's call it resistance to really pee everybody off. We've had loads and loads of touches. It's super obvious. Now, from an SMC perspective, there's going to be lots of resting liquidity here. Or maybe there's other SMC guys who don't agree with it and have their own fancy bells and whistles that they've created, thinking that their method is really, really powerful, right? You will see loads of examples if you look for it where this works just fine. Just fine. Now, even better than that, I can then come up with some other theory and say, yeah, but the reason for it is because when we broke these lows down here, the orders were taken on this side. We actually caused prices to rocket down. But because they moved down here, they then want to go and test these again. We then need to come back up to here. And this is where the volume is most likely to be because, I said so. And then prices are more likely to move down. Obviously, that's one I've come up off the top of my head. But hopefully, my main point here that you can see is you can make up a theory that sounds great about why prices are doing what they're doing, but it is only a disguise. It is a cloak to disguise the fact that no one, not me, not you, knows truly what is driving prices most of the time. You may have an idea, you may have a theory, you may have a strong theory, but you don't know for sure. That is one of the things that makes trading so difficult. It's one of the reasons why I say that technical analysis on its own isn't the source for a highly profitable strategy. Yes, you can be protected by higher risk rewards. You can take advantage of long tail randomness. And what do I mean by that? For anybody who wants to refute that as well, down below is if you have a normal environment, the distribution of returns will look something like this. It's basically a traditional bell curve. For example, if we use the example of height, the average height in your country, we would imagine that most people fall in the mid range of this category. And then we have the extremes, like the extremely tall and the extremely short on either side here. This is a normal distribution. However, in FX or a lot of trading environments, what we have is we have something referred to as fat tails. You can read about this in Nassim Taleb's book, Fooled by Randomness. In fact, I'll write that down. Good book. Fooled by Randomness. Talks about this concept. Now, why is it so relevant? Why is, these fatter tails, as they call them, who cares? Fatter tails means that unlikely, unpredictable events are actually more likely than you might think. And so basically, he presents many ideas about how to exploit this and what this means for everyday market participants. But it basically means that unexpected events are more likely to happen than most people give them credit for because of these long tails. So next piece of information, technical analysis and the random walk hypothesis, right? So the random walk hypothesis is basically the idea that prices are just random if you test them over a large enough sample size. If you do this without changing market conditions, you will find that most prices are random, especially in the FX markets. So what does this mean? Well, if you look at algorithms, so when I went heavily into the algorithm space for a number of years, what did I find? If you test pretty much any algorithm, especially ones that trade more frequently, and you backtest it as far back as you can, you'll find that at some point they will fail, and they will fail significantly. This took me ages to really understand. I'll try, hundreds and hundreds of systems trying to avoid this fact. But it's because I wasn't factoring in a simple thing, and that's that market conditions change. But even deeper than that, it's not just that market conditions change, it's understanding why they change, because you can't replicate that just with backtesting, just using technical analysis. If you incorporate the other things that go into driving prices, it gives you a better idea. Things like geopolitical situations, employment trends, interest rates, basically economic health indications and economic health expectations. Knowing these things is going to give you a clearer idea of why something is maybe beginning to change in the market, why the market conditions may be beginning to change, how they might be beginning to change. But it adds a layer of analysis that most people just don't want to do. But this is particularly important because when we're looking at the random walk, things appear especially random if you don't take these things into account. One thing you'll find is with a lot of studies, when they study just one area, such as just technical analysis or technical analysis and sentiment or just fundamental analysis, every form of analysis has weaknesses. And so if you just incorporate one of them exclusively, you're going to be extra vulnerable to that weakness. And in terms of technical analysis, or pretty much just any time where you're just focusing on one system or one type of analysis, but especially technicals, you're going to be especially vulnerable to this market conditions changing, right? Very important. But this means, in terms of this, is it means that things are going to be random unless you have a clear reason why they wouldn't be random. People can go through pockets of 300, 400 trades where the system works well, but then the next 400 is like a terrible condition for their strategy because they don't know how to forecast the environment and forecast that type of market environment, and that is a disadvantage. I don't care what type of system you use, whether it's SMC or any other just pure technical system, or even in some cases a pure fundamental system. Of course, depends on the time horizon you're trading and all these sorts of things, but it's just something to keep in mind. So a large body of research questions the effectiveness of technical analysis. Studies such as technical analysis and the random walk hypothesis argue that patterns are largely random and don't offer consistent predictive power. Moreover, can technical trading strategies create value? Tested a variety of technical strategies and found only marginal success, often due to random data. I would recommend reviewing these studies. They're actually quite an interesting read. Next one, behavioral biases in trading. Behavioral finance research such as noise trader risk in financial markets shows that traders often see patterns where none exist, a cognitive bias known as apophenia. This explains why many retail traders believe in specific patterns being manipulated by quote-unquote smart money, when in reality, these patterns are a result of randomness or chance. This was a difficult one, and I'll be honest, for me to let go of when I first kind of came to terms with it, because for so long, I'd invested so much time in learning all these patterns that for someone to come along and say, no, those patterns are bullshit. Yeah, no, it's just you being fooled by like basically a weakness in your own brain. That was really hard for me to accept because I'd poured so much time into understanding and learning these patterns and whatnot. But for any of you that want to see this for yourself, test 1,000 trades, not 100, test 1,000 trades with a random system with the same risk management preferences versus another system with 1,000 with an actual strategy. And if you find that your particular strategy has a certain edge, that's probably going to be true for this period. But I guarantee you, if you then stretch that over 10,000, it's going to be very hard to do manually. So, if you're going to do this, I'd recommend back testing it on with an algorithm on MT4, MT5, something like that. You'll see that the further back you go, the less likely it becomes that it's going to consistently perform. You'll either get a net break even or just below break even system, maybe a little bit above, but a really negligible amount, or it will blow the account completely. This will happen over and over and over again with pretty much anything if you go back far enough. And the exact same thing is true for a random system. You'll go through periods where it will look like it's working really, really well. You'll go through periods where it blows. Maybe one blows slightly more than the other or whatever, but these are tiny, tiny microscopic differences to an edge. They're not the type of big edges that most people online are looking for in terms of actually making money from trading. Okay, these are small edges. People will inflate them to make them sound better. But in reality, if you're just using that, you are going to run into issues. Now, of course, there are some exceptions to this, but they are not using the traditional methods of trading that probably most of you are familiar with. They're not just using technical indicators. They are much more heavy based on finding edges through risk management rather than through technical analysis. Okay, now technical analysis is anything from support and resistance all the way up to really complex smart money. It's all technical analysis repackaged in different formats. That's the main point I'm trying to make here. Anyway, relevance of this. Empirical studies show that technical patterns are often random, and there is no evidence that large institutions use them to manipulate retail traders. Instead, behavioral biases are more likely to be responsible for those beliefs. So this is something that I was talking about in the video where I was going on and talking about how it manipulates you using what I like to call the uncertainty scam. This is, in short, the idea that because the markets are uncertain, that is uncomfortable for us as human beings. And as a behavioral response to that uncertainty, we seek a feeling of certainty. And what could give us more certainty than someone coming along explaining to us exactly why something is happening? Oh, this price moved up here because it's taking the highs, which is where the liquidity pool is, and blah, 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 blah. It makes my ears bleed at this point. But again, I have been trading for over 7 years now. So please excuse me being slightly more negative and pessimistic than I'm sure a lot of you are. That is just something that has come to me with time. Anyway, let's go to the next one. So there's just some additional elements of empirical research that I think are important to consider as well. I have kind of mentioned these in different ways already, but I do include some other studies here. Random walk theory, just for a little bit more of a solid look at this, is one of the cornerstones of modern financial theory is the random walk hypothesis, which posits that stock prices follow a random walk and cannot be consistently predicted using past information. This is the key, guys. What is technical analysis based off of? The premise that the past will repeat itself in the future, right? A random walk suggests, right, prices cannot be consistently predicted using past information. That doesn't mean past information is useless. It means that past information on its own is near useless. Technical analysis only looks in the past. You can use the past to forecast the future all you want and say that it's forward looking, but it's still based on the past. This is extensively covered in A Random Walk Down Wall Street, which is a really, really popular book. And it remains a widely accepted concept that directly contradicts the predictability espoused by SMC. And then the final point that I will leave you with is market microstructure theory. We've already talked a little bit about market microstructure. But in market microstructure and asset pricing, oh God, man, my tongue's starting to get twisted with all these words here. O'Hara presents how the intricacies of order flow, liquidity, and market making contribute to price formation. This decentralized process of price discovery leaves little room for the consistent manipulation claimed by SMC proponents. Now, I want to leave you with one final point. Yes, you can find SMC strategies that work. Yes, you can find SMC strategies that work when back tested. But every single strategy that is based purely on technical analysis, including SMC, without any other interventions, will eventually lose. And so this is really the big illusion, because what most people will do is they'll have a period where, let's just say, they do well. And based on this period, they'll be like, oh, my system works. Let me share it with others. These are those who choose to share it with others, many don't. Once they've done this, all these people will sometimes for decades be like, oh, well, we know that this system works, so let's, use it in our own way. And then eventually they'll fail a lot, and then they'll find their own version of a system that works based off of it. And then these people will go and they'll share these. And it will go on like a expanding chain over and over and over again. But the problem is that it doesn't take into account what the performance of this particular system was after the person started writing about it or sharing it. You don't know. Most of the time, you will find that they then went through a period of terribly losing. And so what most people are doing is they're copying systems of people that have, at best, this is assuming they've done their own due diligence that they even trade at all, right? They will go through and they'll look at this and they'll be like, oh my God, these guys did really well. These guys really know how to trade, or this guy or whatever, this girl. And so it will create this bias, this confirmation bias. And based on that, they'll start making their own decisions. They'll ignore, or they won't be available to them to see how badly that system then performed, unless they go and do their own proper due diligence on these systems. And so it's very easy to look at something like SMC and find thousands of examples where even after 100, 200 back tests, it looks like it's working. You're going to find that with any system if with most systems, if you tweak them in the right way. So that doesn't mean that SMC is special, but it also doesn't mean that SMC is necessarily the big enemy. The enemy isn't SMC. The enemy is that technical analysis, or TA, is the holy grail, that it is all you need. And this is a lie. Anyway, this is the best way that I could put together right now of why I believe firmly that SMC is not the way forward. It's not that it's not the way forward, as I said, but it is that it is not the proprietary, incredible system that everybody seems to think that it is and talk about how it is. Instead, the important things is, how do you understand the environment you are in? Market conditions changing. How do you know that today's environment is going to be the ideal environment for those technical rules? Technical analysis is really useful for framing high risk reward scenarios, or even just normal risk reward scenarios, because it gives you a consistent way to manage risk. But that way of managing risk only works particularly well in certain environments. And you're not going to get an idea of which environment you're more than likely to go in just through technical analysis as much as anybody shows you. Yes, they may show you examples on the chart, or maybe even multiple charts, multiple examples, maybe even 100 back tests. But even that, because of this, what I'm describing here, is not good enough. It's not good enough. And I'm only saying this because I have gone through this path. I've gone through this with multiple strategies. And eventually you realize that this is just the reality. At least that's how I've come to terms with it and how I have understood it. But yeah, I'm sure I'll get even more hate for this one, and that's fine. Bring it on in the comments. Genuinely, I am open to debate. If you want to come on, we can debate it live, unedited. We can do that as well. It might be a bit fun, but different for the channel. Anyway, hope you've enjoyed this. Take care, and I'll see you in the next one.